Tomorrow, we get the highly anticipated CPI inflation report that should be what it takes to make or break this market. Between a weekly lower high and a daily higher low, there's a lot to consider in today's episode of the Midweek Market Update. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So I want to kick things off on the SPY weekly time frame chart just to remind us that we are ultimately in a higher time frame downtrend with lower highs and lower lows, and because we're coming from lower lows, it's certainly possible that we can search for a lower high, and thus this is a counter trend move in the context of an existing downtrend. From a structural perspective, what would be the ideal location to find one of those lower highs? It would be right here, basically where we've closed today's session. From a weekly perspective, if this is a lower high double top from here to here, the neckline retest could be the first place to produce a weekly lower high. And also, as a reminder, we have a gap tangled up on the daily chart here as well. So beautiful confluence as time continues for a potential gap fill reversal to get a weekly lower high. The next logical place would be a retest of the bottom of the double inside bar range and also the origin of the FOMC breakdown point from here. If we extend this to the left, we also remember that there's lots of weekly price history from there. And if we go to the right, again, you can clearly see how there's yet again another opportunity for a weekly lower high. The reason that I bring up both of these locations is because if we pull back, then we have a weekly lower high. If we rally, there's still an opportunity for a weekly lower high. Obviously, you have to start thinking about a more meaningful daily higher low in that area, but that's really the peril of the daily chart we'll talk about in just a moment, to really neutralize the weekly trend and to say that, okay, it's neutral, the buyers and sellers, neither side really has an edge. You need an equal high closer to 450 into the end of this week. Seems like a stretch of the imagination. Let's take a look at the daily time frame chart here to start to explore the daily trend reversal. If you think about the daily trend, I would say it's now neutral. Remember that we had highs, lower highs, and this was the last lower high in the sequence because yes, we did flip into an hourly uptrend to ultimately find that rejection point and set the daily lower high. And not to insult anybody's intelligence, but obviously we do have ourselves a higher high in the most recent count. Along the way, we had lows, lower lows, lower lows, lower lows, and lower lows. The origin of this rally is the lowest low in the trend count, so therefore it's only fair to say that we have a neutral daily trend and we're waiting for a daily higher low to confirm that yes, the daily chart is flipping into an overall uptrend. And you can clearly see now how the push and pull between the weekly downtrend and the potential for a daily uptrend does not make this area easy to navigate on the day-to-day moving forward here. If we're taking a look at structure, we did produce an inside bar on today's session, not producing a higher high, but also not producing a lower low. The more important look to me is taking a look at Tuesday's bar, where clearly the upper wick started to reject the overhead gap. And that begs the question, if stronger buyers were truly getting involved in this market, why were they unable to close the gap all the way? Remember that a gap represents an area with no price history, no structure that we have to contend with as resistance. You'll also notice that we've rejected the upper bound of this week's expected move, and over time, as we continue to trade underneath the 50 SMA, it will continue to move in the downward direction, offering confluence for a potential gap fill reversal and daily 50 SMA to act as resistance. That level is 438.50. Nothing has really changed about that. If we do get a pullback here, what else is going on, right? Obviously, if we get the pullback, there's still an opportunity for, yet again, a daily higher low. So this push and pull is what's going to make this area right here, in my estimation, a massive battleground for the S&P market. Ideally, the higher low is found over 430 because that's roughly where this breakdown really stemmed from after we set the failed gap up and the daily lower high, the last one in the overall sequence. 430 would also represent not giving back any of the Friday rally from last week. Technically speaking, yes, we could find ourselves a daily higher low over 427.50, but if we go any further than that, what you'll start to notice from a Fibonacci perspective is if we come in from the low up to the high, is that we would start to be violating the 61.8, and as we know, the general rule of thumb is the more bars that close underneath the 61.8 on any given move, the higher the odds of a full-blown 100% retracement. Which brings me to the next point, where if we do set a weekly lower high, and if we do come back down towards these lows, remember that there's extreme extremely poor structure from an auction theory perspective at the bottom of this overall move. That level is 420.50. So why else would this potentially act as a strong area of resistance? We talked about up, we talked about down. Why would this also offer a strong area of resistance? Let's take a look at this from a drawing set perspective. You can clearly see it would be a retest of the head and shoulders neckline, gap fill reversal, daily 50 SMA. So there's a strong case to be made that the weekly lower high can still be set somewhere around this area. It gets better than that if you start to add in some of the major anchored VWAPs from all of the major pivots after the October low from back here, which is getting dangerously close to falling off the edge of the screen. But nonetheless, you get the point. Anybody who bought in prior to the AI Mania breakout over here is still feeling good about their position. However, all of the AI Mania breakout players, those people have to contend with a massive band of resistance coming from all of the major pivots with an anchored VWAP attached. So once again, strong case to be made that this will provide a difficult area for the market to get continuation in the upward direction through. And even if we do get continuation in the upward direction, let's just go back to our regular drawing set, you can make the argument that this, so just see through some of the VWAPs for a second, still offers your weekly lower high on the retest of the FOMC origin breakdown. 443.25 is ultimately that level. Let's take a look at the hourly time frame chart. What else can we learn about the price action as we head into the end of this week? It's definitely fair to say that the hourly is in an uptrend with lows, and higher lows were found on the pullback of today's session before the end of day rally there. You can clearly see as well that we have highs, higher highs, and higher highs, and this is building out, if anything, as bull flag consolidation on the hourly time frame chart. So we definitely have to concede the point that as long as we're in this range, it's an hourly bull flag. There's really no ifs, ands, or buts about it. If we start to break down underneath 433.65, it begs the question, does this turn into a very short-term hourly double top, lower high underneath, and then you can start to look for that 430 pullback we were just discussing on the daily time frame chart. Before we get too granular with the pathing, let's go ahead and just put the anchored VWAPs on, or excuse me, we'll get to anchored VWAPs, but first Fibonacci is right, 38.2 confluence with that 430 area of pullback that we were just discussing on the daily time frame chart. We do not want to look for the technically speaking higher low still over 425 because that is underneath our 61.8. Once again, something that does rotate down here, is it possible that from a technical perspective this is a higher low? The answer to the question, again, technically is yes, but you would be underneath that major inflection point, the 61.8 from that perspective. If we come in from the FOMC high to the low, just a reminder that the 61.8 is seemingly acting as a resistance point here where we're struggling to get continuation in the upward direction. So is this a logical place, once again, for the sellers to step up and set a weekly lower high? To me, the answer is yes. And then again, the push and pull continues because the 38.2 is also confluence with your 430. So if I had to simplify this chart for anybody watching at home, the main levels to have on your screen into the end of this week, 436 and 430. Those are the major points where the market will be doing battle to determine whether or not we get a weekly lower high or a daily higher low. Last thing we'll put on here is our anchored VWAPs, then we'll explicitly outline the pathing for you. And what do we see from this perspective? Possible confluence over time with 430, right? Maybe these start to slowly creep up into the end of the week and provide confluence at 430, but nonetheless, we are above all of the anchored VWAPs from all of the major inflection points, FOMC breakdown, major low that was set, lower high that was set, and of course, Friday's low as well. That, of course, has to remain more bullish than bearish as we move into the end of this week. So what does that leave us with for pathing into the remainder of the week? Let's be very explicit with it. Of course, our main thought is that any consolidation here leaves the door open to a break higher low above. This is where you get involved on the higher low above, turn prior resistance into newfound support. That way risk reward is tight, and then we can search for the next weekly lower high closer to 443.25. You're pushing your luck if that happens into the end of this week, and also the market internals would not entirely support that. The sector distribution would also not entirely support continuation of this overall rally. So I have my doubts about upside, but if we remain for hourly bull flag consolidation, it is what it is. If we gap up and over this range for tomorrow's CPI print, a pullback that gives us gap fill reversal also puts those same odds on the table. If we open in range and we break down underneath the neckline of this as a double top, as we just pointed out a second ago, this is how you trade that to the downside. You're looking for a lower high underneath, then rotating down to 430. Here you start to re-question your position, reevaluate the position. Can we find a daily higher low, or do the sellers just slice right through it? If we move right through 430 with no support from the buyers, I would be willing to bet that 425 is the major point that we're looking for, considering that we have thin structure here and thin structure here from the rallies. We'll show you that on the market profile in just a moment. If the market does gap down tomorrow morning, I would either be looking for a gap and go, because anybody who positioned long at the top of the overall move would start to feel terrible about their trade location. They're underwater on that position. I think we have the potential for a gap and go, or if we do even close the gap, then of course you're looking for a rejection off of 433.65, today's low of day, for a gap fill reversal. So those are the two primary situations. It all resolves upon this moving higher or lower out of this as an hourly balance. Let's get into some supporting evidence that might suggest why I might favor the downside into the remainder of this week. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, let's focus on Tuesday's session because that's where the failure to close the gap overhead really came from. Individual volume flows are substantial, up and over positive 300 million into the close. The advanced decline line is in trend higher zone, and the cumulative build over on the tick is well above 2,000 by the time noon comes around, which is a classic threshold for an intraday. Okay, yes, check the box. This is a substantial rally. So to see the ES future not even get into the gap, to see the cash ETF look into the gap and fail so aggressively, to me, is a bit of a red flag when all of the underpinnings of the entire New York Stock Exchange would have suggested strong buy-side activity, specifically on that Tuesday session. If I open up the volume reads, what you'll notice here, the historic breadth was double digits positive when we attempted to close that gap on Tuesday's session. If there's ever a time to close a gap, it's on double-digit positive internals. I mean, you're talking about 12, 11 to 1 positive on the NYSE. Really doesn't happen that often. And once again, to see the market completely fail, even ahead of the news announcement, right? It's not like the news announcement failed us there. We were struggling before the news was released. The Fed started speaking, right? And then we rotated lower aggressively. To see the market do that, again, raises some red flags about the true strength of the underlying buyers as of right now. To me, it's still short squeeze in the upward direction. Now, I'm not pounding the table here for a full-blown, Armageddon crash, new lower lows, because it would be hard to argue that the internals here are postured in a bearish manner. I mean, we certainly closed positive breath, positive breath, positive breath. A little bit of a struggle here back down to the zero line, but it was positive on today's session, recovering nicely on Monday. The only thing that's a little bit more bearish on the entire screen is the cumulative build from today's session closing in the negative territory. And that's sort of a bit of a concern because if you take a look at today's price action, we did make a higher high into the close with that end of day rally. The advanced decline line made a lower low. The only thing that made a higher high was the volume read. So do you really want to be trusting new money buyers here at the top of this move? To me, it still seems like the potential for a weekly lower high is greater than the continuation of a massive rally in the upward direction. Market internals are always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And this one tells a slightly different story, a little bit of a two-sided story here over on the market profile. For the most part, let's begin with value area and point of control. Here's Friday's value. Monday obviously migrates higher, as does the point of control on a bar-to-bar count. Tuesday, higher as well. Point of control also higher. And today's session, slightly overlapping to down. Point of control is slightly lower as well. In the grand scheme of things, value has been shifting higher with this overall rally. It's not like it's been floored or overlapping to down the entire way up. So that would tell a little bit more of a bullish story. The other thing here, which is incredibly important to understand, is that technically the sellers also had a massive opportunity on today's session to break down underneath this area of single prints here. And you can clearly see that they did not materialize in the downward direction. So if stronger sellers were going to be present in this market, they should have had no problem rotating through this string basically of incredibly thin structure in the market, getting us to the next one to the downside, which is underneath 43.62. You can see the single prints from back down over here. Beneath 43.62, we closed the singles to half back of the Monday session, which is closer to 43.45 and so on and so forth, right? So the sellers also had a big opportunity on today's session, and they did not really capitalize on that movement. Now, could the market be waiting for CPI? We had PPI this morning, really a nothing burger there. It's possible, but for the most part, the market profile actually neutralizes the narrative a little bit and says, hey, we don't have stronger buyers and we also don't really have stronger sellers in relationship to the thin structure here. And of course, we know the implication from the Tuesday and the interaction with the gap overhead. So jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that at the top of the list, we see the XLRE for real estate up a whopping 4.32%, followed by utilities, communications, and then consumer discretionary. At the bottom of the barrel, the only red name this week is the energy sector, down about 0.5% right now. What I want you to really make note of is that the real estate and utility sectors are extremely rate sensitive, and those are extremely lightweight sectors as well. To see lightweight sectors really pushing and leading this market rally does not give me a warm and fuzzy feeling about this rally having any sort of holding power as we move forward here. Really, you want to see rallies led by the heavier weight risk-on sectors, which, as we know, the heaviest weight risk-on sector is the XLK tech sector. Don't get me wrong, it's still up substantially, 2.23% on the week, but it is not leading in terms of relative strength. Let's take a look at these structural charts and just evaluate what's going on. The real estate sector, oversold move potentially, really just responding to rates pulling back a little bit. I would not be surprised to see some sort of lower high underneath this overhead supply. And once again, as a lightweight sector, even if this does continue in the upward direction, it's not enough to make or break the market moving higher if the XLK starts to move lower. And we'll talk about the important structure there in just a moment. Same thing with the utility sector. Outperformance here, really lightweight sector rebounding from this overly aggressive route. We're up and over what you could conceive as a double bottom on something like an hourly chart, but once again, still a strong opportunity for something like a weekly lower high anywhere underneath 61.40. So we're going to move along from that one. Communications does strike me as interesting because along this entire pullback in the S&P as a whole, the communications sector has gone sideways. There's been incredible amounts of relative strength in communications, and starting to see this break out of this as an overall balance is extremely interesting. If this can truly break out and get price acceptance over 68.10, is that enough to carry the broad market higher? I would argue the answer to that is yes, as long as the XLK is not pulling back aggressively. As long as the XLK is at least going sideways, communications would be incredibly helpful for more of a turn on the SPY daily trend, which could potentially offer a weekly trend change if we can get an equal high closer to 450. So we're really projecting that, but just making note that communications is a sector to watch considering the relative strength and the attempt of a breakout out of this overall balance. Really something to watch the next couple of weeks here. XLY, it didn't really do anything impressive. If this is going to be a double bottom, you need to get over that neckline. You need price acceptance back above this prior inflection point here at 163.25. As a heavier weight risk on sector, if this just consolidates, it's a step in the right direction, right? Higher low, but it's not really helpful until we're over 163.25. Next up, industrials, a little bit of a heavier weight sector, about 8% of the S&P. Still an opportunity for a weekly lower high. Daily 50 SMA confluence right now on the retest of 105. So sure, continue to stretch the rubber band, still looking for a weekly lower high here. In terms of neutral outcomes, consolidation would be fine, digest the move. Higher low could be achieved over 101, and you could start to imagine how this turns into an inverted head and shoulders. One step at a time, but really it's the XLK that's make or break. So let's dive into this one. What do we see here? It's certainly more centralized in this as an overall range, and if this is going to truly be a look below and fail on more so of a weekly balance, and I think we're off to a good start. I think there is the opportunity for a weekly higher low to be found anywhere over 166.50. If we do get a pullback here, not the end of the world, as long as we do not rotate back down underneath that 166.50. If we get straight up continuation, obviously that's also helpful. So the XLK is at a big inflection point here because if we do get the higher low, then great. Technically, we have the look below and fail that we just outlined. If we do not hold there and we go back down to an equal low, I would start to become much more concerned about a weekly lower high, right? And that's your nail on the coffin. Back down underneath 163.50 pushes this, lower, and obviously the S&P lower as a whole. Right now, we did gobble up the inverted hammer. We do not have an inside bar on the daily chart here, and we did close at a higher high. So a little bit of relative strength in the XLK. It's possible. It is possible, keeping a very close eye on 166.50. If we do pull back, obviously upward pressure is upward pressure. Next up, XLB, what's going on with materials, lightweight sector, not doing anything, caught up in this range as a whole. Financials, something to reckon with here, especially as we get financial earnings into the end of this week. JP Morgan is the big one reporting. Is there not an opportunity for a weekly lower high up against 33.65? This chart seems to suggest a threat to me at this point in time. Breakdown underneath 33, and I think you kiss it goodbye. If we're consolidating above, there's an attempt for an inverted head and shoulders. You still have to clear that neckline at 33.65. Again, JP Morgan earnings on Friday is the big one to watch out for. Next up, XLP. This is a lost cause. I mean, just completely downward pressure for the market as a whole right now. Even if it just consolidates, it's not going to be all that helpful. Remember also, this is a D for defensive sector, so it doesn't strike me as something to be overly focused on right now. I think the XLC is the story to watch, and the XLK is the story to watch. Let's take a look at the XLV. What's going on with healthcare's second heaviest weighted sector by market cap? This one definitely is giving us the neutral outcome we were looking for. Recall that would just be sideways in this as an overall range. So ideally, we'd love to see it hold 130.25 last, but certainly not least energy, the only red name on the sector lineup this week from a weekly perspective here. And you can see that it's just been a sloppy sort of mess ever since breaking down from this as an overhead range. A weekly lower high has potentially been set. You're looking for follow through for an equal low on the 84.50 level. If we start to break down underneath today's low, the hammer might suggest that we're just more in store for sideways here as it tries to build out another balance range, and then we'll be patient for a break or a break. And remembering that E for energy is lightweight, not really concerned. Once again, the main sector story right now is the communications breakout and the XLK possibility for a look below and fail. Here is the sector ratio grid. If you're not familiar with this screen, there's a video tutorial on the top right on how to set it up. Overall, I would maintain the stance that the sector ratios really suggest more of a market in turmoil here, with the XLK outperforming slightly, the XLV moving in the right direction, but really more so sideways in the grand scheme of things. Financials are experiencing some pain. The XLY is weak underneath a descending now 50 SMA. Communications continue to outperform. It's been that way for quite some time. Staples as a defensive are not really a threat right now. Utilities are trying to bounce back, but obviously after that big spell and big rout on the structural chart, not really concerned. Again, market in turmoil here from a ratio perspective, and I think that mostly aligns with the battle between the timeframes if we're talking about a weekly lower high and a daily higher low. Here's the XLK versus the XLU. We know that we got a little bit thrown off with this rotation to make a higher high when the utility sector was being absolutely obliterated, so the potentially more appropriate ratio to look for would be replacing XLU with something like the SHY, which as we know is just short-dated treasuries. Let's take a look at that, and you can clearly see that the tech sector is trying to make a stand, but overall, this more so just mirrors precisely what's going on with the overall market as a whole, right? Highs, lows, and lower lows. So definitely in a downtrend still with the opportunity for a lower high. For a more apples to apples comparison, here's the XLY over the XLP, and you can clearly see that we broke to a new higher high. So if anything, this would be a little bit more so of a risk on indication, balancing out the analysis where we were a little bit more bearish on the market internals per se, kind of building the case for a failure from the buyers on Tuesday's session. Let's start to take a look at what's going on with the dollar over here. And what you'll notice is that we did get a pullback. And this is one of those things that we talked about where because this just went basically straight shot from the bottom all the way up to a new higher high in the sequence, it would be fine for the dollar to pull back and not jeopardize the overall trend. And if the dollar pulls back, obviously that leaves the door open for a little bit of a rally in equities. And this has really made sense if you've been keeping score, I should say, with something like gold and silver, really overextended, really oversold, counter trend move, obviously put some downward pressure on the dollar. Same thing over here with silver. And this is all making sense, right? Counter trend move. Is there not still an opportunity for a lower high on silver, a lower high back on over here in gold, for then continued upward pressure on the dollar and then downward pressure on equities? This, to me, this relationship overall with metals and the dollar right now would be more so indicative of a counter trend move in the context of an existing downtrend, more aligned with the weekly narrative that we've been talking about. Let's take a look at the TNX, what's going on with our 10-year interest rate, pulling back aggressively. And once again, this has been a helping force, right? As this pulls back in the TNX, it's been a helping force for higher over here in equities. No big disjoints from that perspective. However, we do have to just remind you that from a technical perspective, this is still very much so in an uptrend. It just produced a brand new higher high. Is it not reasonable that we could catch ourselves for a higher low and go back to the equal highs? Absolutely the case. So we're not out of the woods from a rates perspective, especially if we start to consider the stance of the Fed right now. Let's take a look at the inverted ZT. This is starting to show a little bit of a rolling over effect, putting us more firmly in the midpoint of this range. Would be more indicative that we are not going to get an additional hike from the Fed. Let's take a look at the tracker tool now. So higher odds for a pause, lower odds for a hike should not come as a surprise considering what we just saw in the inverted ZT. Same thing for the December timeframe and same thing for the January timeframe, if we take a look at the total probabilities here, what you'll recall if you take a look at this column, it's probably pretty small on your screen. Let's zoom in a little bit more so on that for you. This was representative more so of a 40%, roughly 40 to 45% odds of a hike in the December timeframe before we got the labor report from last week, and also before some of the comments from Fed members on Tuesday and today's Wednesday session. If we take a look at the calendar, the economic calendar that is, this morning we got PPI. We'll talk about PPI in just a second, but tomorrow it's all eyes on the CPI. CPI is going to coincide with unemployment claims, and as of right now, the expectation is for a cooling of inflation, but just a very mild cooling of inflation. If we miss here, it's very easy that the Fed could come out and say, hey, in the SEP we outlined 5.6, we're going there, and you could suddenly start to see those expectations move back in the other direction, closer to 50-50 odds for a hike in the December timeframe from the tracker tool. Here's a breakdown of the PPI from this morning, and something that's very interesting here, and by the way, this is from Liz Young over at SoFi, so always giving credit where credit is due. You can find the Twitter handle up here, but this is a Bloomberg snapshot, of course, from the terminal, and this breaks down where the final demand, aka PPI, was coming from. What I want to point out is that the Fed mentioned that they were going to look through energy inflation, and this is what they start to mean by that. If you take a look at the prior reading of PPI, energy is in purple here, it made up a substantial portion of PPI. If you take a look at this reading that we got today, it's a smaller portion, okay? So by looking through energy and the volatility that's there, maybe they're doing the right thing, but CPI truly has to move in the downward direction. Otherwise, again, wouldn't be surprised to see them take out that back pocket situation and say, hey, one more hike in the December meeting. One thing that I do find interesting here is that services inflation remains the sticky part of inflation, right? And that is in blue. You'll notice that it accounted for nearly half of the PPI inflation that we got in the last month's read. So keeping a very close eye on this, I do believe the market will have a more substantial reaction to the CPI. We'll do a full breakdown for the weekend update once those numbers are out. From an earnings perspective, we talked about how on Friday, it's all eyes on the financial sector with JP Morgan reporting before the open. Keep your wits about you from that perspective. And as we just talked about on the financials sector, the chart itself does not look great. There's a very strong opportunity for a weekly lower high. You got to make sure that they really come in with decent numbers and the stock itself is moving in the upward direction. Let's jump back on over to the platform and take a look through some of our risk appetite charts. TLT ratio to the S&P is always up first, and what you'll notice is that it, of course, is still underneath a downward sloping resistance trend line, but if you take a closer look, it did start to zoom in, or it did start to move higher on today's session. And the main point, the reason I bring this up, is because if bonds continue to catch a bid here and the equities market does rotate lower, this is in a prime position right now, not only for the bonds to squeeze in the upward direction, but outperformance here would be the classic return of the flight to safety trade. So really watching this very closely over the next little bit. If we do set a weekly lower high and bonds start to outperform, if this really is the beginning to kick off a short squeeze, classic flight to safety, that would be a very bearish indication for the markets as a whole, or at least a period where you would probably not have an overly aggressive risk appetite for equities down below. Let's take a look at bonds in relationship to one another. Obviously, with rates coming in a little bit, you can see that this also is pulling back, but still, let's not forget that these are in overall uptrends, indicating some sort of uncertainty, favoring the shorter end of the curve instead of the longer end of the curve. I do think that it's short-term uncertainty because if we take a look at credit spreads, what you'll notice, and we'll zoom in on this as well, is that on the shorter duration credit spreads, certainly a stronger tick in the upward direction. Longer end of the curve, little bit more mild. I mean, don't get me wrong, it still certainly did produce a higher high, but not nearly as aggressive. So to me, it seems as though the market is pricing in maybe some sort of more aggressive pullback from a weekly lower high. And then if we can just go for an equal low, undercut, clean up the structure, and then start to rally, maybe if this comes down in a respectful manner and credit spreads tighten back up, it would be more of an indication that, okay, we've cleaned up the lows, maybe we'll start to look for something more constructive to happen in the future, which would be why the longer duration credit spreads are not as aggressively widening up here on top. That's just sort of a, we're projecting a little bit out there as to what may be a situation. Obviously, no one knows what's going to happen in the day-to-day here. We're just sort of doing our best to forecast what the possible scenarios are and how we can respond to them accordingly, right? So with the HYG, just zooming in here to illustrate that there is no major divergence in the short term. If you've been watching the channel for the past couple of weeks, really, you know that if we bring it on out to a yearly chart, though, obviously the major divergence is the fact that this has broken down underneath the range and there's the possibility for a lower high here. Not to say that we belong all the way down here in the ES or the SPX as a whole, but directionally that vector would point in the downward direction. Let's take a look at Bitcoin because there is a threat brewing over here on Bitcoin. And throughout the major rout, the last big drawdown that we've seen after FOMC, Bitcoin actually held up sideways as the quote store of value. But now you can start to see how it is producing after this little breakdown we saw so far this week, a little bit of a head and shoulders pattern. If this really breaks down, there's thin structure off to the left, wouldn't that be something if the S&P equities catch a lower high on the weekly and then Bitcoin breaks down, right? So that store of value really becomes no longer. So watching out for that as we move forward. What about market breadth here is new highs versus lows. Substantial move in the upward direction back to the zero line, but let me just remind you what 2022 looked like, right? We spent plenty of time at the zero line. There's nothing saying that we can't roll over there and continue in the downward direction. To really avoid a more bearish market, you need to be above the zero line, even if it means that we're just slightly above the zero line. You cannot afford to be negative on new highs versus lows. Let's take a look at the SPX A200R. This did make a move in the upward direction again. Counter trend move on the weekly time frame chart here. It really shouldn't be all that surprising. Still underneath the 50% mark though. And if we take a look at the SPX A50R, this one was the most oversold of the breadth readings. We talked about this a week ago today, and it did make a move in the upward direction, but once again, still underneath the 50% mark and still an opportunity from a trend perspective to produce some sort of lower high here. If we take a look at what's going on with the RSP, equal weight S&P 500, it might look pretty positive at a first glance. Great, we've recaptured the 140 mark, but let me just remind you that on a relative basis, we are nowhere even close to the FOMC follow-up gap down. So a relative divergence absolutely in the bear's favor here on the equal weight S&P. If we take a look over at let's go to the Dow divergence. Where's the Dow? There it is. And what we'll notice here is that transports are actually holding up around that 14.7. So nothing crazy from that perspective as of right now. Let's take a look at the VIX. And we'll see what's going on with volatility here. Pulling back off of 2050, but let me also remind you and counter that with the statement that we're still up and over 15, so volatility is slightly elevated here. Let's take a look at the VVIX volatility of the volatility index underneath the 103 precursor, just as a general reminder. If the market's going to see a stronger route to the downside, typically this will make the move over 103 first, then your VIX capitulates, and then you start to see that larger drawdown in equities below. The saving grace is for all of the purists out there tracking volatility futures. These did move into a much deeper contango over the last couple of trading days as the market has rallied. So this is more comfortable in volatility futures, indicating that the curve is proper, and asset managers basically under this environment are more likely to allocate capital as opposed to when we're closer towards that zero line. One-day VIX is still elevated, indicating again on the day-to-day, don't expect volatility to go anywhere, especially with CPI tomorrow morning. QQQ weekly time frame chart, just to point out, very similar to our XLK. If this is going to be a look below and fail, we are well on our way back towards the top of the overall range. And yes, technically this did produce a lower low, so we are technically in a downtrend, and we find ourselves at the perfect backtest level as of right now. So it's do or die for the bears, specifically over on the Nasdaq side of the market. If they are going to produce a lower high, it probably wants to be found almost instantly here around this 371 level, right? If you're thinking about this as your prior daily double top, and this is the FOMC breakdown, you pretty much want to reverse instantly right here on the daily to produce your weekly lower high. But notice there's a strong opportunity for a daily higher low, and I would even go so far to say that the QQQ daily is already in an uptrend with lows, higher lows, and then big time higher high being produced as soon as, or as recent as I should say, today's session, closing up and over the Tuesday high from the upper wick. We're nowhere near the gap down from the FOMC, and we're already closing at the origin of that breakdown point. So all of the FOMC route has been undone as of right now over in the Nasdaq. We still have ourselves mostly an inside bar, but it's not as neutral as the S&P. Definitely more so of a bullish edge here over on the Nasdaq. Clearly effectively also recapturing our daily 50 SMA. There's not really a rejection yet of the upper edge of this week's expected move, so if anything, it leaves the door open to a little bit more upside before technically being, quote, overbought, just purely from that perspective, right? Remember, markets can always remain overbought, can always remain oversold, but from that perspective, weekly expected move, there's still a little bit more wiggle room in the upward direction. Any pullbacks here, again, clear opportunity for a daily higher low anywhere over the top of the prior balance down here. The ultimate line in the sand would be 361.50. If we do fall back down underneath that, again, it starts to be a little bit too much give back to really consider this a just normal pullback. Notice that your 61.8 Fibonacci is confluence right around that level as of right now. Let's move on to, let's actually take a look just to remind you as well that there never was the breakdown of the Man Ray pattern. Remember that this is your classic Man Ray. There's the little head, right? So this never broke down underneath the neckline. So there is no neckline to retest and provide some sort of weekly lower high. So from that perspective, once again, a little bit more relative strength over on the Nasdaq side of things. I'm really glad that we still have the major trend channel pulled up, because is it reasonable that we could pull back off the upper bound of the trend channel? Absolutely. But again, there's still a strong opportunity for a daily higher low on something like your Nasdaq compared to the S&P 500. Let's take a look on a relative basis where we are in relationship to the anchored VWAP studies. This is the lower cohort before the AI Mania breakout. This is the upper cohort. We went straight through it, and right now we're currently sitting above the highest anchored VWAP in that overall sequence. So again, relative strength over on the Nasdaq side of the market. If this is going to be helpful for the S&P, it really boils down to financials being the one that needs to start pulling its weight in the upward direction. And as we just saw, this is all going to hinge upon JP Morgan earnings on Friday before the open. Let's move on down to an hourly time frame chart for the QQQ and get granular with our levels. Again, hourly uptrend very clear, hourly bull flag very clear. If this is going to turn into a triple top, I would really just call it a balanced breakdown at that point in time. Needs to come from underneath 368.50. If we do start to break it down, there's a very short period of time before we get to 367. Certainly an opportunity for support there. Daily 50 SMA and also the prior bottom of this area here. So you have resistance, which led to the breakout. Remember that this is after the NVIDIA failed gap up earnings, right? That's the short squeeze. And this is also prior support from back here. It's also prior resistance from the Monday session. So 367 has a lot of importance to me. If you are going to try to short the breakdown of this as an overhead balance, I would do so mechanically, short the lower high underneath, and then trim a lot of it right here, considering that's your thin structure retracement, the single prints that we'll see on the market profile in just a second. If we get consolidation to a break, as we talked about, there's a little bit more room to run to the upside. Upper expected move is 372.77. Anything beyond that, 376 is your next level. As you can see from over here, thin structure breakdown. So the QQQ, if anything, is probably the place to be looking for a long if the market is going to disregard the resistance trend line we were just showing on the alternate drawing set. What else can we say? Let's take a look at the anchored VWAPs from an intraday perspective. Above all of them, obviously, here's your Friday anchored VWAP. That, if anything, is going to provide confluence into the end of the week, maybe with that 367. So again, do not overstay your welcome on that. And if we do slip underneath, the better short, the best short as of right now in the QQQ is waiting for the stronger lower high underneath 367 to get your deeper pullback to here, and then reevaluating for your possible daily higher low, higher low, certainly a higher low on the retest. You could start to think of this as a very sloppy double bottom, right? Break, retest, higher low on the daily, offers that higher low around that 361.50 that we were just discussing. Same situations we talked about with the S&P gap. If we gap up, it's gap fill reversal most bullish. If we're inside of range, obviously you have your situations. And if it's a gap down, it's gap fill reversal. In the QQQ, I might be willing to suggest that a gap down is not as bearish as the S&P. Remember in the S&P, I said that if we gap out of range, overhead supply is going to be a burden to the downside. Not as convinced in the QQQ. I think if anything, there's a stronger opportunity to fade a gap down in the QQQ for a rotation higher. Let's take a look at the market internals for the Nasdaq side of things. We did not get substantial inflows on the Tuesday session, but again, we didn't fail a gap on the Nasdaq, so I'm not as worried about that over here. Decent battle back on Monday, but still technically negative. Tuesday is in trend higher zone today. A little bit more brutal, getting underneath the zero line over here in the advanced decline line. The cumulative builds on the tick are a little bit more aggressive in the downward direction, so maybe this balances out the slightly more bullish analysis over on the hourly chart that we were just looking at. Very similar to our S&P. This did produce a higher high into the close. No higher high, obviously, out of the advanced decline line. An equal high, I would argue, in the volume reads, and hardly anything substantial out of the tick specifically. So not convinced, and I suppose if anything, still keeping an open mind for more so consolidation. Like maybe the NQ boils down to say, okay, the S&P can pull back, but the Nasdaq is more so looking to go sideways and consolidate these gains instead of break down to resume some sort of major weekly downtrend. Let's take a brief glance over at the SMH just for some supporting evidence. This, of course, is going to be your semis ETF, and we'll just go back on over to our classic daily time frame chart to begin here. And what we'll notice is that there was a stronger rotation up and over this 147.25. So because we've broken out more aggressively over this, as maybe you could consider an inverted head and shoulders, now there's a stronger opportunity for the daily higher low, and this lends again itself beautifully to the weekly look below and fail. So tech does have a little bit of an edge structurally from this perspective, but once again, some sideways consolidation would not be unwarranted for the QQQ as a whole. Let's take a look at the QQQE for the equal weight. Oops, we forgot the E. Equal weight QQQ. And what you'll notice here is that this is in sync. This is in sync with what's going on over on the QQQ weighted. There is no major divergence from this perspective, which is dissimilar or not the same as what we just saw on the RSP equal weight S&P 500. Last look for the Nasdaq side of the market is going to be over here on the market profile. And you'll also notice that did we technically look into the string of single prints from the Tuesday rally? Absolutely did, and obviously we found price acceptance higher. Today's point of control also migrated higher, and the value area, instead of being overlapping to down, was more so just contained. Look at the extremely poor high on today's session, lack of material excess from the Tuesday session as well. I would not be surprised if the market needs to repair this, and you can see in the post market right now, ahead of CPI, again, this is all subject to change at 8:30 tomorrow morning, but this to me could certainly be a gap fill reversal, repair the poor high, and then look for continuation in the upward direction, or if we do fall back down into range, further bull flag consolidation on the hourly, then looking for a break potentially early next week. In the spirit of consistency, here's the IWM weekly time frame chart. If this is an overall balance area, obviously we're trading more towards the upper edge of the lower third, and there's still a very strong opportunity for weekly lower highs to be found on any counter trend continuation all the way up against 182.50. Let's move on down to the daily time frame chart now that the context has ultimately been set. And this has been participating in the upside. Monday and Tuesday did rally. We find ourselves at the upper edge of this week's expected move thus far. But is it slowing down? I would say yes. We broke to a new higher high. We technically have a higher high and an indecisive doji closing back in the midpoint of this as an overall range. We didn't reject at the cleanest opportunity for a daily lower high, but obviously from a daily trend count perspective, there's a strong possibility for a lower high to just be set here. So the main watch on IWM is 174.75, an extremely well-defined daily pivot zone, and we'll see on the hourly as well. If we break it, right, it's very easy to rotate all the way back down towards the hammer time area, which is around 172. If there is going to be anything more constructive, I would argue it needs to break higher out of the two-day balance. If you want to count this as a two-day balance, retrace, and then get something that looks like this. You could start to make the argument that sure, we have some sort of inverted head and shoulders, you get a daily higher low, and maybe you get the stronger weekly counter trend move that needs to retest the confluence of moving averages and that 182.40 level we just saw as the neckline of your weekly head and shoulders. Here it is on the hourly time frame chart. We've got the anchored view apps already fired up because these are acting as massive support right now. If we're just consolidating in this area, this is the saving grace. If we start to break down underneath that 174.75, if we start failing these anchored view apps again, looking left, if I just take those off real quick, what you'll notice is that there's fairly thin structure under here, right? Boom, thin structure, and then this retracement is thin structure as well. So you're really looking at the next major zone as 172 on a deeper pullback. So again, this pullback, start to get a daily or hourly, I should say, double top under the neckline 174.75, which is also prior support from back here. Just a very clean pivot at this point in time. 174.75 is the major level to be thinking about. And again, even if we do go consolidation to break, still looking for a weekly lower high anywhere underneath 182.40. Next up, let's have a look at the internals for the Russell side of the market. What do we see over here? A little bit weaker. A little bit weaker with today's session specifically. A little bit stronger than the Nasdaq, but weaker than the S&P. A little bit more negative over here on the advanced decline line. More aggressive breakdown out of trend higher zone on Tuesday, which is interesting because Tuesday was just a pure squeeze to the upside. If I zoom in on the futures, morning squeeze, afternoon consolidation. To see that falling out would just be representative that, hey, across the exchange, nobody was really interested in buying into the close there, right? This consolidation was a bit weaker than it might appear if you're classically just thinking of this as bull flag consolidation. Same thing with the cumulative build here on Wednesday with today's afternoon rally. This did not make a higher high into the close of today's session, hence the red indecisive doji on the daily time frame chart. Let's take a brief glance at the market profile for the Russell side of things. And this is, again, when you see things back to back like this, always more indicative of an indecisive market. Can't make up its mind. Short squeeze, liquidation break. We have lack of material excess and lack of material excess, technically poor low at the bottom of today's session. Value areas are opposing. You have obviously here and here. Points of control are opposing as well. Considering that this is kind of that pivot point, breaking down underneath opens the door for low. I would start to think about a deeper retracement towards this area here. 1750 is technically the hammer high zone that you should be most concerned with. And then underneath that, you do have a small string of single prints left, about 10 points lower towards 1740. In the interest of time, let's do a speed round through the core list of companies here. What do we see on Apple? Certainly a 100% retracement producing an equal high, which means that we can afford a daily higher low at this point. Anything that remains over 174 is good to go. Honestly, I thought it was going to happen today with the inverted hammer rejecting the overhead gap and closing underneath the daily 50 SMA, but clearly on today's session, we've closed at the highs of the overall range. Let's take a look on the hourly time frame chart just to get a bit more granular with the game plan here. Any consolidation builds out hourly bull flag, and then of course, yes, the gap overhead is in play. Over 180 closes towards 180, 150. Any further consolidation that then breaks underneath 177.85 turns this into an hourly double top. You're underneath the neckline. Lower highs start to search for a daily higher low at 174, like we were just referring to. Here's Netflix. This is turning into a disrespectful ticker, very similar to Meta and the Metaverse. Clearly, look below and fail, move towards the top of the range, over the top of the range, failed completely in one fell swoop all the way underneath the bottom of the range now. So what's the name of the game? You're looking for a lower high to be set outside of this range before you trust it in any particular direction. That lower high is just anywhere underneath 370, 325. If we rotate back into the range, this really falls lower on the list of priorities of places to be looking for setups. Let's take a look at Tesla because this is the exact opposite. Beautiful setup unfolding here with a higher low potentially retesting what was once resistance, clear breakout, obviously. Higher low on the table as long as we're over 261.75. Consolidation, position early for bullish breakouts, whatever you want to do here. It's up to you to manage the risk, engage the risk in there, but the break is over 268.50. You do have to contend with this breakdown around 271.75. So let's call that, roughly about a 3-point move in the upward direction. The larger target is the top of the prior balance from back over here at 277.50. I would prefer to maintain more of a bullish stance on Tesla, considering this mild pullback producing the higher low. I would be slightly more concerned if we do rotate back down towards 258 and get a lower high underneath 261.75, but first reactions here need to just be bought right back up. There is the potential for a daily higher low still around 258. So that does still play, but just not as clean as an initial hold of 261.75. Next up, what's going on with Google? Straight shot higher, closed the gap overhead. This one's just marching in the upward direction. Here it is on a daily time frame chart, just to show you the context. This is not something that you see often, and it's very difficult to actually get involved in, right? We talked about bowing to the downside, just being completely inorganic price action, the dollar to the upside, completely inorganic price action, very similar here in Google. So I'm not thrilled about trying to participate on a higher high after a 100% retracement without a firm daily higher low, pullback being offered. So I'd be a little bit more patient here on Google. Technically, the hourly levels would suggest that as long as we're consolidating over this number here, 139.33, the bottom of the original gap, technically you're putting an hourly flag and then looking for a break. But, again, I do not feel comfortable executing on Google at the higher high in the sequence under these circumstances. I would prefer to see a daily pullback that looks for a higher low. I mean, a daily higher low could honestly be anywhere over 135, kind of where this aggressive break started in the first place. Let's take a look at Metaverse. This is kind of what I was likening Netflix price action to. Fake break to the upside, fake break to the downside, fake break to the upside, just wild, right? So Metaverse is finally cooperating and making a clean move in the upward direction. If we take a look in the daily time frame chart, we just exceeded these highs. Is it not logical that Meta could produce a daily higher low pullback? I would love to get involved on something that's clean to 319, then look for continuation in the upward direction. Even better would be a deeper move to 310.75. That way we can trade for here, and that would be more so in alignment with the broad market as a whole, because then if the broad market does produce a higher low, there's much better upside to be trading for out of Meta. If the broad market produces the weekly lower lower high and does not hold for a daily higher low, then you're just looking for a rejection here, and now you're also positioned for good structure on a potential short in Meta. So no matter how you slice the cake in Meta, I do think that this is one to contend with into the remainder of this week for a pullback, offering something at 319 or 310.75. Straight up continuation, there's some room to run overhead. 335 is the number. I would like to get involved after a pullback there. Let's take a look at NVIDIA. NVIDIA is an interesting one. Again, no daily lower high really produced up against a key level or even weekly lower high, right back up towards the top of this area in here over this little breakout point. Let's take a look in the hourly, and what you'll notice is consolidation happens here over 461, and then breaks are over 467, continuation in the upward direction. That upper target is 482.50. Again, I would probably be partial for a pullback, not wanting to get involved at the higher high. Better pullback is either, something that does this. That's a strong one on the daily. Actually, I'd probably be most interested in at 452. Let's continue along again for the sake of time here. What's going on with Softy? Daily time frame chart, not really, again, offering a clear setup on the daily, just these very incremental higher highs, which is fine, but I would prefer to see some sort of consolidation range found and then a break out of some sort of range to get to that next overhead target on the hourly. I think you can kind of get the sense that higher lows are on the table, but just where are they formed? It's not so clear. I think that the balance range perspective is more so the ideal outcome. Could you technically get a break for a short on a lower high underneath 328.25? Yes, and there is some room to run in the downward direction. If we need stronger shorts and there's relative weakness on Microsoft with just the lack of participation in a gap up, if there is, just pullbacks across the broad market and Microsoft is down on the market minder window the most, I'd probably be looking over here for a breakdown through that thin structure if we need stronger shorts on the day. Last but not least, Amazon, the mini beast for our normal lineup, daily double bottom, yes, break finally out of this really interesting range, especially after that session from back here. Yes, so higher low was found above, great rotation in the upward direction, gap overhead is the main thought. Over 132.25 closes the gap, 135.25. Pullbacks are a-okay for a daily higher low over 129. Failing under 129, kiss this thing goodbye. I do not want to touch it back in this range, all because of this one singular day back here. Really not thrilled with Amazon Nancy's price action on that particular day. Under 129 gets a little bit sketchy because you start thinking about weekly lower highs, right? And just a failure to rotate through this gap. We're going to segue right into the trade idea, which is on MMM, Triple M. What's going on with MMM? I'm going to clear up this drawing set and we're going to zoom in on the daily. Potential for an oversold bounce to continue here with an inside hammer. So I think that the setup is very clear over 91, and here it is on the hourly time frame chart. If we zoom in, you could start to build the argument for some sort of like cup and handle, of course, and then of course looking left, incredibly thin structure. So going back to the origin of this breakdown brings you to 92.73, offering roughly $1.75 of upside here on a stock that's priced sub 100 as of right now. So I certainly think it's worth paying attention to for upside. The options chain leaves a little bit to be desired in terms of liquidity. If you want to trade it with shares, it wouldn't be a bad idea here in MMM. If you do go with options, just be mindful of the spread and make sure you're choosing a strike with enough liquidity to support however many contracts you ultimately want to take to get to your normal position size. So 91, that is the break level. Thin structure off to the left, target 92.75. If we just consolidate, I would really want to see it stay above at this point, roughly 90 flat. If we can consolidate in here, it builds out the cup and handle. Still looking for the break if we start to slip underneath. Really not interested considering the aggression of your daily downtrend. I mean, this is not, that's no joke. That's no joke. This is a counter trend scalp that we're looking for ultimately, right? So that's going to wrap up today's episode of the Midweek Market Update. If you enjoyed the episode or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. Tomorrow is coffee and donuts up in the penthouse for our CPI news release, 8:30. Be there sharp. And yeah, we'll have a good time. So with that said, we're going to wrap up the video. Have a green trading week.